Hello, listeners. Welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Rob Larity and I are back at it for our weekly update on geopolitics and markets. The weekly update will be going on hiatus for the next 2 weeks as I go on paternity leave, but we will be back in a couple weeks. In the meantime, we will have some Monday episodes coming out to keep you all satiated with that geopolitical content that you love. A reminder to rate the podcast or review the podcast if you haven't already. You can also sign up for the Cognitive Investments Global Situation Report if you want written content delivered to your email every week. Check us out at www.cognitive.investments, or as always, you can just email me at jacob@cognitive.investments. So we recorded this on Wednesday afternoon. We usually record on Thursday afternoons and put this out on Friday morning. So if things are a little out of date, please forgive us. We've got good reason for it. So cheers. See you out there. I'll catch you all in a couple weeks.
Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. All right, Rob, so nature was kind to me this week. I'm back. It's Wednesday. We usually record on Wednesday, so we're in the middle of the week, listeners. So if World War III starts tomorrow, sorry, it was bad luck for us. How's it going, Rob?
Really well. So you got a big day coming up in the next short term here.
Yes.
Feeling good about that?
I feel great. I've recorded a bunch of podcasts already that will come out in the next couple weeks. So you won't actually hear from me as an actual father for weeks from now. But no, I feel as good as I'm going to feel. I feel like you're not supposed to say you're ready, but I feel ready. Like I'm ready to do it. So I don't know. I'm sure I'm not. I'm sure I'll find out soon that I'm not. Well, let's dive in. Let's start off just kind of with what you're seeing in the market this week. I think you wanted to touch on the U.S. in particular and maybe even U.S. real estate, but what's on your mind this week market-wise?
So the U.S. market is at an interesting place now. If you remember, it was back, I think, in the last week of May or right around there that we were starting to get much more bullish about U.S. markets and shifting our own positioning and talking about why we were more bullish. And it's really funny because that was only, 3 months ago, and now it seems like a lifetime ago because the sentiment has completely changed. Back then, it was doom and gloom and, market crash 2.0 and run for the hills. And now it's a much more mixed picture. So most of the sentiment indicators have reverted back from Armageddon levels to medium levels, which is interesting. And, right now I'm becoming much more cautious and we're becoming much more cautious. And here's sort of where we are. The consensus has definitely changed. So back in May, the consensus was that the energy spikes were going to tip the U.S. into a pretty severe recession. And that seems to have faded, that belief now. And it seems like the consensus has shifted to a much more optimistic one, especially as gas prices have continued to fall, as crude oil prices have fallen. And you can see that. So the retail numbers came out for July yesterday, and they were stronger than expected. Retail sales in the U.S. grew. If you take away gasoline and take away auto sales, which are impacted because there's no cars to buy right now, U.S. retail sales grew month over month, which a lot of people are interpreting as, a sign that the Fed is going to be more hawkish again, that they're going to really clamp on the brakes from an interest rate perspective. That is not totally clear that that's the case. So the Fed meeting minutes came out just this morning, and it looks like there were some interesting anecdotes in there where the members of the Fed board were saying, we can see that we're having an impact on the economy. So that's all to kind of lay out where the debate is right now. Is the average market participant thinks we're doing okay. And if you look at like Walmart reported a few days ago and put out pretty good guidance for the next quarter. And I think that's a good sign of where we're at. We went from big recession to, okay, we had an inventory sell-off, an inventory liquidation that was needed, but the underlying fundamentals are really strong. And you can see because all of those consumer cyclical companies have rebounded very sharply to reflect that change in the consensus. But the problem now is if you look at a lot of these stocks, like Walmart, for instance, Target, Costco, a lot of them have now kind of cleared that, we call it oversold conditions from a few months ago. So they were really in the hole, the stock prices, sentiment was really negative. And now they've rebounded enough where they've returned to more of an equilibrium. And not to get too technical, but a lot of them are sort of now back into the congestion zone of where they were trading a year or two ago, where it's going to take another impetus to really drive another leg higher for a lot of these. And that's the case if you look beyond retailers, like look at Ford or Tesla, or even stocks like Microsoft. They all look sort of similar. So a lot of the extremes that we were talking about back in May have healed, and we're in a much more kind of neutral environment right now.
Yeah, I listen to the Saxo Market podcast sometimes just because I think they always have interesting things to say, and they're a good way of, I think, putting finger on the pulse of the market. And the podcast they published yesterday, the title was something like, does the market have altitude sickness? But they've been bears for like the last couple of weeks, so I almost feel like they keep on saying, "Oh, like it's not gonna work," and things keep like inching up and up. I wanted to. I mean, this is totally anecdotal, but I was at Home Depot this morning with my wife because we had one of our gutters was wrong, and I just needed a little piece for the gutter. I was at Home Depot at 11 a.m. on a Wednesday. It was packed. I did not see any recession in Home Depot at 11 a.m. in the morning. Because the contractors have already bought all their stuff. It was like, folks like me who are out there getting stuff. So I don't know. That was kind of a weird thing too. Are you still thinking, you sort of alluded to this, are you thinking the Fed is going to be more hawkish, or do you think the Fed is going to have to back off, or do you think the Fed is almost maybe unsure of it itself and is trying to decide that internally?
I think the Fed is relatively unsure. Because the data is mixed. As you point out, demand is still strong. And we talked about this. So anyone who is watching this on our YouTube channel, you can see we put our webinar presentations and videos that we do occasionally when we have something actually interesting and big to talk about. And back in...
I think we have something big and interesting to talk about every week, Rob. Don't sell it short.
really big relative to all the fascinating stuff we always talk about.
Yeah, shorting his own podcast, guys. That's a brave strategy.
When we're not just shooting the shit on a weekly basis.
I think this is brilliant.
But if you go back and look at that video, so we put out a piece on the U.S. economy and sort of made this point that like the underlying health of consumers is pretty good. And at that time, I think we put that out in, early May or something. We were just saying, you're having an inventory liquidation, just like you saw during periods in the late 1940s when you saw a similar sort of inflationary volatility in both directions, but that the underlying health was pretty good. And that seems to be what's coming out. The one exception to that, because I see that and that's a data point that I'm focused on, but the one thing that gives me pause is the credit cycle is looking pretty weak. And especially if you go into the lower tiers of the income spectrum. Now, a lot of those people were squeezed by gas prices and food inflation and those issues. So some of that is backward looking. But if you look at some of the stocks, like look at Capital One Financial, right? Like the classic credit card issuer. Look at Ally Financial. Look at PRG, which is a buy now, pay later company that focuses on lower tier consumers. All of those stocks look like junk. They're just bleeding out. And if you really were seeing like a significant relief kind of rally and everything was all clear, I would really want to see those stocks leading us out, because they were the ones who got hit in many ways first and worst. So I'm sort of dancing around because I don't have a strong view, and we're sort of waiting to see what the data is. But I think the Fed is probably in a similar situation.
Yeah. How does this intersect with housing then? Because I know you said you had housing on your mind and you wanted to bring up some points about that.
Well, the housing thing, I guess the noteworthy aspect of housing right now is obviously demand is getting crushed because of where mortgage rates are, and inventory of homes for sale is up a lot year over year, even though it's from a very low level. And I think a lot of people, myself included, I sort of saw a scenario where housing prices could really come off the boil very fast, like much faster than expected. But the thing that has surprised me and makes me less confident about that now is the number of people who are putting their homes for sale has started to decline again. Now, I had thought that everyone knows demand is going down, and that there might be an expectation that prices are going to come off the boil as well, and that would cause people who were sitting on the sidelines to put up their homes for sale that were considering doing so. But that's not been the case, and that's a surprise, and that's really noteworthy because it means something's gummed up in the housing market. And I don't know exactly where that goes, but what you're seeing right now is sort of stagnation. List pricing hasn't come down that much. The number of transactions has gone down. The demand for homes has gone down as affordability has tightened with mortgages, but supply has also gone down. So you're seeing some healing in the inventory of homes to buy. There's no longer this crazy scarcity mindset, but you're not seeing this onrush of supply that would result in home prices being down 10, 15% year over year, which I think is a plausible scenario, but not really if you don't get people listing. So,
is it too simplistic to say just that? I feel like the real estate or mortgage analysts that I've followed, at least at the beginning of the year, were talking about the Fed having to take their foot off the gas pedal and seeing rates lower at the end of the year. Do you think it's as simple as people don't want to put a house up for sale if they know that, or if they're expecting that the Fed will lower interest rates and then mortgage rates are going to come down and they can charge more for the house because it's more affordable that way? Or is that too simplistic a way of thinking about it?
I don't know. I think there's something to be said for the fact that anyone who has refinanced into a lower interest mortgage, people think of their homes in terms of carrying costs. They don't really think in terms of the price so much. They think, how much do I have to pay every month, and how much of my income is that? So a lot of people are currently carrying very low costs because they've got mortgages at 3%. So if you're going to sell a home where your mortgage is 3% and you're going to flip that into a new home where your mortgage is 5.5%, that's a very difficult proposition, because on a monthly basis, even if you're, all else equal, you might be paying significantly more. So I think that's a big aspect of it.
All right, well, let's turn away from the US then and check in on China. I know you said you're sick of China. I'm not quite sick of China yet. But I do want to take. We should begin a segment where one of us gets on our soapbox and rails about sort of mainstream press. I feel like, and I'm going to pick on Reuters right now, but it can be literally any newspaper or any media. But when China slashed some interest rates, and it wasn't a ton, it was 10 basis points this week. They said, "Oh, China unexpectedly cuts 2 key rates. It's a surprise." Is it really a surprise? I mean, like the whole system is flashing red. They haven't been able to stimulate credit like they thought they were going to. Like, I'm pretty sure that all of these mechanisms that they were going, like, they're going to do whatever they have to do to bail it out. So I was kind of miffed by that. But the People's Bank of China did lower interest rates a little bit. They seem to be trying to stimulate the Chinese economy a little bit. Do you have anything else you want to add there before we sort of take it to the follow-on effects or some more interesting things that are tied to the China issue?
Well, I guess the only thing I would add would be a question for you, which is, there's sort of, there's always a time element in what we do, and nothing is ever static. And one thing that I've been thinking about is, every week that we're here talking about this and you don't get a rebound and you don't get stimulus flowing through and you don't get a reacceleration in credit growth, I become more and more uneasy about that, because the problem is very clear, and certainly they know that there's a significant problem, and they're very on top of this. Like, they know, like, all the things that we blabbed about in our treadmill to hell podcast a few weeks ago. Like, that's all common knowledge among policymakers in the upper levels of the Chinese state. So why aren't they doing anything? What do you think?
I think you have your finger on the thing that is most concerning about this for me, which is that, and this sort of gets explicitly geopolitical. Like, if it was up to the decision makers in Beijing and the Chinese Communist Party, it would already be stimulus town. Now, they want to do it a little more surgically. They're talking about doing it responsibly, but they've been telegraphing for weeks now, okay, like, we're going to have to be a little bit more serious about this and let growth fly. It's not translating because it seems like the local governments and the local area banks and provincial officials, they're not going along necessarily with what the Chinese Communist Party is doing. And we had that FT anecdote a couple weeks ago. There are more anecdotes sort of coming out of Chinese banks just not willing to do what Beijing is saying. So Beijing can pull all the levers that they want, but if the local banks are not lending, if the system is not working, if sort of further down the chain things are not happening, that's a disturbing sign, because then that means the local officials and the provincial officials either don't trust Beijing, or they think that what's happening is going to not be in their interest, or maybe they think they're going to lend now, but then they're going to be made an example of in 2 or 3 years because they lended irresponsibly. It's that breakdown in the system that concerns me. But the reason I'm still net optimistic is that I just don't think the Chinese government has gone at it as hard as it can. I think they've tried to sort of be a little more precise and surgical about what they're doing, and they still have tools if they want to go full hog, but they don't seem to be going 100% to me. They're sort of slowly turning up the dial and trying to see if they can not back up the dump truck of stimulus, if they could just kind of do more surgical things and make it happen. So I think you're absolutely right. They haven't been able to do it yet, but they also haven't turned the dial to 10. They're like slowly kind of turning the dial up. Now, maybe you get into a situation where if you're boiling the frog, that even when you go to 10, because you've been slowly inching it up, like, nobody's going to actually respond to the real sort of crisis point. But that's what I see. I see the central government trying to be a little more balanced. I see local governments and local officials and local banks not buying it yet. And there's that disconnect that makes me a little bit nervous, because if the central governments and the local governments are not on the same page, like, now there's a whole model of Chinese history of when the locals start ignoring what's coming down from the emperor on high. And it always ends badly for the emperor in the end. So,
well, I always take the approach that Mr. Market will tell us the answer before we read it in Reuters or some Wall Street report. And so far, Mr. Market is not doing much. So iron ore prices in China are basically doing nothing. They're kind of clanking along on the floor. Now, they're not going down. They're not making new lows, but they're not rebounding, for example. And the same with junk bonds and all of those things. So I guess TBD for now.
TBD, but that's the perfect segue into, if you've been listening to this podcast for a while, you know that we are bullish on Japan. You know that we're bullish on some Latin American countries. So the segue is good for Latin America, and then we'll come back around to Japan and touch on it at the end of the conversation. But we cut some positions in Latin America this week because of some of this nervousness. So why don't I tee you up there to talk about specifically why some of these China-related concerns make us a little nervous about some of the things that are happening in Latin America itself.
Yeah, I mean, not to overcomplicate it, it's essentially those the positions that we had, which were in Brazil and Chile in particular, have had an extremely strong run in the last few weeks, in line with this kind of broader emerging markets rally. And it was a good opportunity to just leave there because, they are significantly exposed to that Chinese-driven demand. And, I just worry about that. I think there's a lot to be concerned about if that rolls over because, try what they might, that's a big part of what keeps the boat from tipping over in those countries.
Yeah, I mean, so much of the global economy still depends on China. I think both in Chile and Brazil, we've got political issues too. I mean, Brazil's going into an election cycle that I wouldn't say Bolsonaro has evened it enough yet to give him a puncher's chance, but the polls are narrowing a little bit between him and Lula for the first time in this whole process. Oil prices are going down at the exact right time. He's got some stimulus that he's handing out. Everybody's freaking out again in the media about, is the military going to have to intervene? Is Bolsonaro going to go January 6th on this? I mean, that's happening in Brazil. Chile, I mean, that constitution, if you believe the polls sitting here today in a couple of weeks, doesn't look like that constitution is going to pass. And that's not necessarily the worst thing. It would be worse to pass a constitution that nobody liked, probably in sort of the aggregate. But it definitely creates more uncertainty and more problems for the Chilean government on top of, hey, copper demand from China might be flagging or is uncertain. So when you add sort of all of those things into the cocktail, it's not a real great picture, I think, for Brazil and Chile in particular for the months ahead, but just kind of the region in general for at least in the short term.
And do you think, sort of the outcomes that we've seen in the Chilean constitutional debate are within our expectations or your expectations that we laid out 4 or 5 months ago?
I hesitate to say which it is because there's a limit to the extent that I trust the polls. I learned not to trust polls after Brexit and after Donald Trump's victory. So I'm not ignoring the polls, but I see that there's a large, it's a large group of undecideds in Chile. There's a lot of people who just hate the Constitution, and then there's the people who are for it. Are people actually going to not show up? Are people going to vote against? Are people going to vote for? So with that proviso, no, I was more optimistic. I thought that once the Constitution got through this rigmarole, that what would come out the other end would be something that a majority of Chileans would vote for and would be happy with. The constitutional process went just about how I thought. All the crazy ideas got whittled out. And what you were left with was a fairly long, but I would call it a fairly vanilla document compared to what people were afraid was going to be in the document. But the fact that it's just not translating and that at least the polls are telling us the Chileans don't like it, that's a worrying sign. I thought that once they got through that crucible, that they would come out the other side with something that they were satisfied with. They might still. Look how long it took the United States to write a constitution and for everyone in the United States to agree with it. So if they were able to do it in a year, we'd be talking about what the miracle of Chilean democracy. So it's not necessarily a bad thing and doesn't break the model that they weren't able to do it in a year. But I was not expecting for the referendum to fail. I thought they were going to get to September and they'd have something and they'd pass it. So just on that level, I'm a little more cautious too. But who knows? It would not surprise me if we got to the polls and people voted for it anyway. So last but not least, kind of tied to this, I think both Chile and Brazil are examples of countries that it's not great for them what's happening in China. Japan's sort of an interesting one because Japan still has a lot of exposure in China itself, but just about everything else in the macro geopolitical environment seems to be bullish for Japan. And we have a pretty big bet on Japan. We haven't talked about them in a while. So what are you seeing from Japanese sort of equities this week that's got you excited?
Well, the thing that is noteworthy about Japan is if you look at some of the key indices. So one of the ETFs that you can follow is the DXJ, which hedges out the currency exposure in Japan. So you're just getting exposure to the underlying stocks in yen terms. That's breaking out to new highs and new long-term highs. I don't have it in front of me, but I think it's a decade high, which is a real outlier. You don't like what other country in the world right now is making new highs? There are none that I can think of. Maybe some, maybe Liechtenstein or something that I'm not following very closely. But that's a major thing. Like that's a major flag. We've been talking about this, and part of our thesis on Japan, on top of all the fundamental stuff that we've talked about with sort of the transformation of the country and them accelerating their investment and all those geopolitical oriented things. Part of the technical argument is just that Japan has been mired in a bear market for 25 years. And if you look at the behavior of Japanese stocks, they appear to be trying to break out of what is a very, very long downtrend, right as all of these big picture geopolitical tectonic plates are shifting. And I think that's really interesting. And if you look at what Japanese stocks are doing right now, that seems to be a confirmation that something big is potentially going on.
How much of this do you feel is tied to the weaker yen helps Japanese exporters? So how do you feel like that is playing a role in this at all, or is that more ancillary?
I think that's the traditional view, but I'm a little skeptical of that because that's been going on for a long time. And everyone has always associated, strong Japanese equities with weak yen. And, Japan is a big exporting country and so on and so forth. I don't think that the connection is nearly as close as sort of the mainstream press makes it out to be. Because Japan is also a major importing country. So on a net basis, in many ways it nets out. Like if you look at Germany, for instance, Germany's in a similar situation. Like in the 1970s, Germany experienced something very similar where the Deutsche Mark was absolutely ripping against the dollar. And because like Japan, they had the benefits and they were a big importer and exporter. It didn't really matter that much. Like Germany did quite well, economically speaking, and in market terms. And Japan, I think, is in a similar situation. On top of which, a lot of these Japanese exporters have diversified their manufacturing footprints outside of Japan into other countries in Southeast Asia. I guess the last thing to observe would just be the Japanese stocks are making new highs, and the yen is not close to its lows. It's 135 today, and it was at the bottom 140 to the dollar. So I don't think it's that.
But you think the yen is going to strengthen too, right? Or is your confidence shaken?
Well, I think we have a pretty significant bet that it will, which I was focused on this morning because it's at the precipice. And I think if it goes against us, then I'll throw in the towel and look for another thesis. But yeah, that's still my thinking. And a lot of that is going to be tied to long-term interest rates. Because again, if you look at what has been driving the dollar against the yen, as well as other currencies, it's the interest rate differential. And what you saw this morning, so we put on, we increased our long yen exposure. And then you saw this retail number came out, like I mentioned before. And the dollar rallied and short-term interest rates rallied I'm sorry, interest rates went up. So depending on how you look at it, the yields went up. Expectations for interest rates went up. And dollar yen went up. But this afternoon, that's coming off the boil again. So this is very much something that's going to be out of date by Friday morning when this comes out. But that's the big debate on the yen is, can the U.S. continue to maintain this huge distance from the rest of the world in terms of growth and interest rates? And if it can't, if it's going to follow the rest of the world in a slowdown, then you're going to see the yen, I think, rip.
Yeah. I guess it is interesting to see that, I mean, and to bring the conversation full circle, I mean, the Bank of Japan has stuck to its guns on interest rates this entire time and hasn't really blinked. They're now, and for a while they were the outlier. I mean, the US was raising rates. Europe, I think, didn't raise rates the way they wanted to because of the war and because of energy inflation, but they've started to raise rates. But Japan has kept steady at basically, zero or around there. And now China's lowering too. So you are starting to get this. China and Japan are not blinking. They're even lowering. Europe and the United States raising rates. There's an interesting sort of push and pull happening there as well. So,
and in Europe as well, I mean, European inflation is much more driven by energy than by labor, which is the case in the US. So if energy continues to roll over, and I understand, this is a nice segue because we want to talk about European energy a little bit. But if that does eventually resolve, that's going to be a big driver of rates as well.
Yeah. Well, let's get right into it. Let's talk about European energy. For me, the big news geopolitically this week on European energy was the Europeans are trying to bring the Iranian nuclear deal back to life. They proposed, apparently EU negotiators proposed that this long-standing IAEA investigation into Iran should be put on ice, because that's what Iran's been asking for a while, to try and re-inject some momentum into the talks. And it looks like there is some momentum. Iran responded to their offer. It seems to me that the main sticking point for the Iran nuclear deal is that Iran is asking the United States for some assurances that if Iran comes back to the deal, that the next U.S. president's not going to do what Donald Trump did and just tear up the deal and end it. So they want some kind of assurance from the United States that this is going to be more than just the Biden presidency. And this is not to say anything nice about the thuggish theocrats in Iran, but that's not an unreasonable ask if you're just sort of thinking outside of the ideology and thinking about what they want. And I don't know that it's a realistic ask, because the only way to do that I can think of is to make it a formal treaty. And I mean, that there's no way that Congress is going to give Biden a treaty of that magnitude on an issue that controversial. So I'm still pretty pessimistic after being fairly optimistic about the Iran nuclear deal. The optimistic take is that the Iran nuclear deal just makes too much sense. I mean, Iran's got the oil, they've got natural gas, they can help energy markets in a major way if you just kind of bring them back in from the cold. And it doesn't do anybody any good to isolate Iran. But the sort of pragmatic interests there have not won the day, and it's hard for me to see that it's going to happen now unless something crazy happens in the United States. I'm not imagining. But how does that intersect with what you've been thinking about in terms of European energy? I think you've been thinking a little more long term than me parsing the secret esoteric meaning of the Iranian foreign minister's comments.
Well, just the comment I made to you before was, it's funny to see, there's a certain class of people who are constantly like looking at historical parallels and cycles and trying to say, this is just like, 1907 and blah, blah, blah. And I don't have a lot of patience for a lot of that. Especially like it, just for the listeners' benefit, if you ever see someone put up a chart of something from the past and put it up against a chart of a market price from today and say, oh, well, it's going to follow, like, that's just nonsense. Just shut it off right then. Like, that is the number one crime of people on Twitter and that, because it looks so compelling, and then you never hear about it 2 months later when it did not turn out that way at all, because history just doesn't work that way. Yeah. Anyway, that's my little soapbox. But there are interesting kind of echoes from the past. And I mentioned to Jacob before that I was just reading a really good book called The Rise and Fall of Classical Greece by a guy named Josiah Ober, who I think is at Stanford. And it's an excellent book, but one of the points that it makes is it talks about during the Bronze Age in Greece. So this was 1200, 1300 BC. Greece was very dependent on the outside for essential resources, which were copper and tin, which you need to make bronze. So if anyone's ever read, the Iliad, all the warriors had bronze-tipped spears and bronze armor. Everything was based on bronze, and it was super expensive and it was hard to get, but everything came from abroad. So the tin would come from Afghanistan. So think about how far that was back then. Mm-hmm. And not to belabor this metaphor, but the interesting thing about the story was it was talking about how the trade routes that they were dependent on just collapsed during what they called the Dark Ages, before the late Bronze Age, because there were all of these invasions by foreign peoples. Trade routes collapsed, the wealth of these nations collapsed, and they couldn't get the stuff anymore. And it was the collapse of those trade routes, the inability, the realization that they were dependent on something that was not sustainable, that spurred the innovation in ironworking that led to this real resurgence economically. And they knew about iron, like iron wasn't some mystery. They just never really took the resources and the time to invest into developing the techniques that they needed to extract it and work it successfully. And that in many ways sort of, I don't want to say revolutionized, but it spurred sort of the emergence of Greece as this economic super region. And it's just kind of an interesting parallel to today, because as Jacob has spoke about on Monday, one of the big ideas that we're focused on, sort of these longer term themes as far as investment opportunity from a top-down standpoint, is the emergence of Europe and Europe's response to all of these threats, to all of these bottlenecks and problems that they're having, and that ultimately that's going to turn out in a very positive direction.
Yeah, there's two parts of that. Being bullish on Europe is a fairly lonely place to be right now. You can find others out there who are thinking sort of that same way, but it's a small group of us who have property on European Union island. It's an even smaller group that is sort of bullish on the European Union despite the energy price spikes. And I don't mean to belittle the energy price spikes. I mean, if you look at the charts of like where natural gas is in the Netherlands, or if you look at what the price of electricity is in France, I see everybody's new favorite thing to do on Twitter is post the energy bills that I saw an Italian energy bill that was like 5 times what it was the previous summer, and anecdotes of, people saying, no, it cost me more. I could have gone on holiday and had a cheaper month than trying to keep my business open and pay 5x on these energy things. Like, there's going to be real problems in European energy markets. But to your point, it's the type of crisis that is going to spur innovation. And there is nothing here that is beyond the European Union's ability to solve. Maybe they can't solve it short term. Maybe we're going to have some problems here in the next couple of months, but those are probably all just opportunities to find the folks who are going to have the solutions in the European energy crisis itself. So if you just hold your nose at Europe right now and say, ew, like I don't want to be there, you're probably going to miss the folks who are pouring capital and ideas into innovation that are actually going to solve the problem. Now, whether is Germany finally going to re-embrace nuclear? Is it going to be hydrogen? Is it going to be some clean way to burn coal? I have no idea what it is, but I feel like if you're just turning your nose at Europe right now because you think, energy prices are going to go up, the Europeans can't handle that. That's not true. I mean, this is like the center of enlightenment and science and progress. Like, I guarantee you they will find a way through the crisis on the other end, I think, anyway. But it's a lonely place to say that. There are not many people who are saying that right now.
And Europe is good at that stuff. They're good at materials, they're good at energy, they're good at engineering. And I think culturally that holds a very different place. We're not used to thinking that way, at least on the US coasts. I don't know very many engineers. I mean, I'm literally on top of MIT, so I meet more engineers than the average bear. But I don't think that's the average experience. whereas my three brothers-in-law and my father-in-law in France are all engineers.
Yeah, France is the one that I find. Let's throw some shade at the French. That's another recurring theme we should have on the podcast, because
This is good because usually my wife has stopped listening to the podcast by the time we get like 10 minutes in, so we have
don't
free
worry.
reign to.
I'll send her a message that she should get to this. Tell her she should just listen on like 5x speed or something. That way she can get through it really quick, and we'll sound like the chipmunks. But I mean, France should be living large right now. Like, they've always like depended on nuclear. Such a large percentage of their mix is based on nuclear, but somehow they just, they didn't upkeep the nuclear plants, and they've got a drought, so hydro sucks. I mean, this should be France's moment, and it really just shows you that you can get so many of the policy choices right, but if your timing is not good, or if you don't upkeep the infrastructure that you have, you kind of miss your opportunity. Because just think if like France's nuclear infrastructure was all working the way that it's supposed to. I mean, they would literally be like at the economic heart of Europe right now, or able to challenge Germany on that score. And now they just look even more incompetent than the rest, because they didn't get cheap energy from Russia for all those decades, and they're not able to pivot when the crisis comes. So,
well, I think that's an interesting theme, not to shift away from bashing France, which I don't like to do because I love the French.
It comes from a place of affection, French people. So,
but I think the theme that I've been thinking about a lot recently and looking for opportunities in both directions is exactly like you're laying it out. The slip between the cup and the lip, so to speak. So you can have all these big plans, all this big talk about energy transition and renewables and nuclear, but in the case of France, they're falling on their face because of just execution problems. And the other thing that I noticed that I was looking at this week was there's an interesting piece that I read from the Royal Bank of Canada, so Wall Street Research, and they were pointing out that in the U.S. there's a massive amount of renewable capacity that's on the way. It's been earmarked. Everyone's kind of taking it for granted that it's in the pipeline. It's going to get built. But the problem is that the interconnection queues, so in other words, the length of time it takes to get approval to interconnect to the grid, to do the environmental assessments, all of the stuff that you need to do when you build any sort of generation capacity, including renewables, that those queues were about 1+ year a few years ago, and now they're at 3 to 4 years and rising.
Yeah.
So there's a giant traffic jam, the administrative and red tape traffic jam to actually build the stuff. And once you do get approved after 3 years now, if you're lucky, it's almost 2 years to actually build the plant. So you're talking about 5-year delay while the pig is making its way through the snake. That's a huge factor when people are taking all this into account in their analyses and talking about the transition to renewables. The inability to build things easily is a theme that we just see cropping up over and over again.
Yeah, and this goes to why, I think in the long run, authoritarian governments have shown that they don't have a particularly, when it comes to resilience and endurance, they usually fall flat on their faces. But when it comes to executing policy changes in response to crises very quickly, authoritarian regimes do have kind of a leg up. And I mean, we're talking about the US right now. I mean, I think that Biden and the Democrats, they were even talking about, the New Deal and trying to call out Roosevelt. And when they got both houses of Congress, that, they were going to author all these changes, and they finally have this Inflation Reduction Act through. But it doesn't seem to me that the U.S. government is serious about the challenges that even the U.S. itself is facing right now, because we're still squabbling about stuff that doesn't actually matter. What happened around the New Deal was that things got so bad in the United States is that they really did sweep in a whole new class of politician, and FDR was their leader. And for a couple of years, he did whatever he wanted, and he could do whatever he wanted because he had all the powers of Congress. He got so arrogant's the wrong word, but he got so sure of himself that he tried to pack the Supreme Court. And that was when they finally slapped him back down and said, okay, like, you've gone too far. But I don't think the U.S. is going to hit any kind of level where this stuff is easy until you get that kind of moment. And I think that's one of the, I mean, I guess it's a pro and con of democracy that it takes that kind of moment where we come together to fix the problems before we can get that level of urgency. I don't see that there's urgency in the United States about some of these energy issues that we're talking about, which goes back to Europe. In Europe, there is urgency. And I mean, if I'm wrong about Europe, it's that I'm misreading the room and that there is no urgency in Europe and that they're going to go back to fighting about the rule of law and, the independence of Lombardy in Italy or stuff like that. I don't think that's going to happen. I think that's actually a really good juxtaposition because it seems to me that Europe sees it as a crisis. And in the US, we could get ahead of this if we wanted to. But to your point, we're not. Like we're just stuck in the bureaucracy and the red tape.
And it's not just energy. I think this is one of the hidden strengths of Europe is the ability to actually do things physically. So the example, I always bring this up, this is my little bugbear, is the bike lanes. So I went back to Paris after COVID for the first time. The city was visibly transformed. A lot of, whole city blocks had been shut down to traffic. There were new bike infrastructure everywhere, public mobility infrastructure, scooters, all of this stuff. Like you could physically just look around and stuff looked different. And here I've been in Cambridge, Massachusetts, which is inarguably the most, unified blue state place on earth. 96% of people voted for Biden. Support for bike lanes is like everyone can get behind that. That's the most uncontroversial thing. Riding bike, greenery, blah, blah, blah. We have built hardly any, not even bike, like dedicated bike infrastructure. We don't even have bike lanes on the streets because on the main street in Cambridge, not to get too local up in here, but it's a good illustration of the broader problem. On the main street, down the street here from me, they tried to put in just a bike lane on the street. And it's being held up until 2026 because the locals don't want to lose parking spots. And there's a guy going around handing flyers through everyone's doors saying that, this is bad for local residents and, they're taking away our parking. There's already not enough parking and all these bikes and that's the reality of every day. So multiply that times 1,000 and you can see why, are we going to build, square miles and square miles of solar panels? Are we going to build, wind turbines all over the country to the extent that we need to produce the kind of energy that we need to affect a renewable transition? It's a big ask. I struggle to see it. Because that's kind of the reality. Like, did you see the new Blade Runner movie, the 2046 one?
It was great.
In the opening scene when he's flying through and it's just a sea of solar panels. Mm-hmm. Like that's, in many ways, that's kind of what it would need to look like in order to hit like a significant penetration of renewable from solar in the total mix. Like, is that really a viable, like, is that what we're going to do? Like, I'm skeptical about that.
No, we're not going to do it at all. And I mean, first of all politics is local. I think that adage is true. And I mean, I was looking at what it would take to put solar panels on my own house because there's, those nice juicy tax credits in the Inflation Reduction Act. And it's a great idea in theory, and I would probably pull the trigger if I could find a reputable company that I would trust to give me a good quote and would come and build it in less than 6 months. But I put my name into some website that they had good Google reviews. Everything seemed fine. And as soon as I put my phone number in to be contacted, I literally got 10 different calls from 10 different numbers trying to hawk some solar thing. And somebody gave me a price that was like ridiculous and astronomically stupid. So it's one thing to put the tax credit on the sheet, but if you don't have anybody who can actually build this stuff, it actually feels like there's more swindlers out there who are trying to make money off of it than anything else. This actually goes back to the pandemic stimulus stuff too. I mean, I think that had to happen, but the amount of fraud that the stimulus money for businesses generated, it's to your point, like the regulation impulse is too tight on some levels and not tight enough on other levels. We'll just throw money at the problem and expect that the money is going to be spent well. So you can have a tax credit and call it a success, but then when it actually comes down to building the thing or having a company that puts it on your house, like none of that exists in the United States, at least as far as I know. And if there's a company out there that does this in New Orleans and you're listening, feel free to get in touch. I'll even let you sponsor an episode of the podcast.
Which isn't to say that the U.S. doesn't have extraordinary advantages. It's just that those things don't play to our advantages, dealing with physical stuff and building things, and because the equilibrium here is hands off.
No, we still do innovation. The U.S. still does innovation better than anyone. I mean, the COVID vaccine is a great example of that. But great ideas and great technology is nothing if you can't implement. And I mean, this is part of the globalization narrative. Like, if globalization works, then China's making things and Mexican laborers are coming to the United States and actually building the things. If you're really going to deglobalize, and that's the path that the U.S. has started down, you're going to have to rebuild U.S. manufacturing capacity, and you're going to have to find workers who are willing to do things that they weren't able to do before. That latter one is probably harder than the former. And I don't think people have quite wrapped their heads around just how disruptive that's going to be, and how the countries that are really going to do well in this environment, to your point, are the ones that already can build things. I think one aspect of how, if a country is going to be good, is can they get access to cheap energy? Europe fails on that sort of example. The U.S. is great from that perspective right now, but then the flip side of that is can you build things? This is another thing that makes me a little pessimistic about the U.S. right now. I mean, if you look at the history of just about every country that has access to cheap energy, like the U.S. has with natural gas and oil right now, it's usually not a good thing. It usually means you sort of rest on your laurels and everything's cheap, so you don't do all the other stuff. I guess Norway is the example against this, but I mean, the Saudis have had how many decades to build a manufacturing economy, and have been talking about it for how many decades, and they don't, because they just pump oil and that's all they have to do. So I wonder if there's a little Dutch disease embedded within the U.S. itself, because we've had this cheap energy now since the Shell Revolution really kicked off.
You sound like Herodotus.
Do I?
Prosperity makes you soft, essentially.
It's not good to make arguments about cycles unless your cycles are at least 3,000 years old and relate to what an ancient Greek historian does. Then it's okay. I think that's good enough. Rob, anything else you want to say before we get out of here?
No, I don't think so. Just we'll see you in a few weeks, and hopefully it wasn't World War III in the interim. Yes,
that would be nice. And listeners, if you want, we will be putting out some content here for the next couple weeks that's been pre-recorded. And if you haven't signed up for the Global SITREP, I've even pre-written content for the SITREP too. So the SITREP is not going quiet for the next 3 weeks. So if you want geopolitical thoughts in your inbox, you can either sign up for the SITREP, keep listening to the podcast, follow Cognitive Investments on Twitter, find the YouTube page. There are lots of ways to get insights, even though I'm going to be gone for a couple weeks. So,
and just as a preview, when Jacob gets back in September, we have a lot of interesting stuff cooking that's coming that will be very interesting. So keep an eye out for that.
Yeah. So otherwise, stay cool, and we'll see you out there. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.